Hi folks, welcome to Business Succession Planning 101. My name is John Fraker, and I am a corporate and tax attorney with the law firm of Ainer and Fraker. So here's a little bit about me. One of the most important questions we get from our clients is how can we evaluate the right law firm to work with? And in addition to being experts in certain subject material, small business law, tax law, so forth, one of the most important questions you can ever ask a law firm is to the attorneys, are you actually employees of a big law firm, or are you also business owners? If you yourself are a business owner, it's important that you work with attorneys who are also business owners. And Ainer and Fraker was founded in 2002 between myself and my business partner, Leon Ainer, and we are shareholders in our company. We are owners. So we know the same concerns that you have, how to not only practice law, but how to hire employees, how to set a payroll, how to set budget, and so forth. These are the most important things that you can have in a law firm, is not only subject material experience, but practical experience. Does their expertise dovetail with exactly what it is that you need from your law firm? So let's now talk about how to choose the right legal entity for your business. So it's important to note that every business has a default. If you do not set up something for yourself, the government will set one up for you. Now the first one, if you are a single person in business, is a sole proprietorship. If there's more than one person involved in your business, it's going to be a partnership. Now there's two very important things to know about these two types of entities. One is that these are pass-through entities for tax purposes. That means that all your taxes flow through to your individual tax return and are taxed there. There's no corporate or entity level taxation at all. The other very important thing to know is that you do not have any asset protection whatsoever when you set these up. They do not offer any protection at all. That means your house, your savings plans, your education plans for your kids, your investment accounts, all of it can be lost if you don't protect your family from your business. We're going to talk today about how to do that. The alternatives, having an S corporation, which gives you pass-through taxation, but also gives you asset protection. A C corporation, those are the ones that you see in the publicly traded companies, the Fortune 500 companies, and so on. These give you both asset protection, but the challenge with a C corporation is that it has the potential for double taxation. That is, taxation at the corporate level and then at the individual level. So if you're going to choose a C corporation for your business, it's important to have a good tax law firm to represent you to make sure you're not subject to double taxation. And then the third one that we see very common here in California is the limited liability company, which is extremely flexible. It gives you the opportunity to be taxed as a corporation, partnership, or a sole proprietorship, and it gives you the same asset protection as a corporation, and sometimes it's even better. So let's talk about a very important concept, because people come to us all the time and say, hey, we went online to LegalZoom or somewhere else and we downloaded articles of incorporation, and now we know that we're protected, so we don't need to work with a law firm, we're good. This is the most important detail in setting up your business, and that is, it doesn't matter what your paperwork says, it matters how you run your entity. Okay? This concept called piercing the corporate veil is a judicial concept, and it says that just the paperwork by itself, whether the articles of incorporation or articles of organization for an LLC, are not sufficient alone to protect your family. It's the way that your company is structured and the way that it is operated that protects your family. Piercing the corporate veil is a judicial theory that says if you fail to honor the corporate formalities and you do not treat your entity, your business, as separate from yourself, a judge will set aside your corporation or your LLC, and your creditors will be able to seize your personal assets. That's something that people overlook all the time. It's not enough just to have the paperwork. It's critically important that you observe all the required formalities to make sure that the veil between you and your business is not pierced by a judge. So let's talk about how to get the most out of your hard work as a business owner. So I put up here on the screen two different categories. One, working for somebody else, and two is what it means to work for yourself. So when you work for somebody else, you're most likely going to make more money up front, right? So in the early years of your career, you're drawing a salary. You are making money whether or not you're productive. So if you come into the office and you're just not feeling it due to a hangover or whatever, you are still going to make the same salary you are when all the engines are firing at the same time. Okay? And the most important thing is, for your retirement, you're investing in your 401k or whatever retirement plan that your company offers. And you're going to be putting money in, and then at the end of your time there, you're going to retire and you'll take your 401k or your IRA and roll it over, and that's the money that you have for your retirement. By contrast, owning your own business, working for yourself, most likely you're going to make less money up front than you could working for somebody else. However, you're only going to make money when you are productive, right? If you're not feeling it, if you sit there and stare out into space or check your email or play on Facebook, you're not going to be making money. If you don't hunt, you don't eat. That's just the rule of small business. Number three, you're investing in your business, not necessarily just in your 401k. You can grow your business faster than you can grow your retirement plan. That's something that you really don't hear a lot from many financial advisors or people who are not business owners, is that your business can actually grow faster than your retirement plan. If you put $100,000 into your 401k and you invest in the stock market, conservatively you can expect anywhere from 4 to 6, maybe 8% return on that money year over year. But if you took $100,000 and reinvested in that business, you hired more people, you hired a new sales team, you invested in infrastructure, well, you can grow your company by leaps and bounds, 10 times, 50 times, 100 times. These returns are almost completely impossible in the stock market, but you can invest in your business. However, the most important thing to know is that you will only catch up when you actually sell your business. In other words, the only time that your revenue and your net worth most likely is going to surpass what you would have working for somebody else is when you sell your business. Okay, when you're able to take your company and sell it to a competitor or a friend or another business in the same field, and you sell it for 5 times your revenue, 10 times, whatever your multiple is, that's the time that you get the full reward for your business, which is why you need to protect yourself and your family at all times. Without a succession plan in place, without buy-sell agreements and other protections, you're just never going to be as safe as if you worked for somebody else. You'll never catch up to where you would have been had you just played it safe and worked for somebody else. So let's talk about what happens if one of the owners of a business, a shareholder or a partner, passes away or is in a long-term incapacity situation. Now, the default partnership rule is that a partnership will dissolve on the death of a general partner. So you need to specify what happens in your corporate documents. If you don't do that, again, the government in the Corporations Code or the Business and Professions Code, it will specify exactly what happens to your business if you don't take care of it for yourself. Now, if a partner dies or is incapacitated and doesn't have the required legal documents in place, such as a living trust, a will and testament, powers of attorney, then your business can fall into the probate court system or somehow come under the jurisdiction of the court, which I can almost assure you will be a tremendous hardship for your company. It's extremely difficult to do anything in the judicial system these days, let alone run a company, meet payroll, contracts, and so forth. The court system is not designed to run your business. You need to make sure that you have other people that can do that if you're not able to do so. So another question we get frequently is, how can we prevent outsiders or heirs of our business partners from obtaining an ownership interest? So again, you have a default. If you have corporate shares, they belong to the estate of a deceased partner. So if you have 2 owners of a business, say it's you and one other person, you each have half the company, 50-50. If your partner dies, their spouse or their kids have a legal right to their 50% of the company, which leaves you really only 2 choices. Number 1, you can pay them the value of half the company, or if you don't happen to have half the net worth of your company lying around in a bank account somewhere, you can make the kids and the spouse your business partners until they are cashed out. That's what we call a lose-lose situation. You are in a bad spot because you are now in business with somebody who doesn't want to be in business with you. All they want is their money, and they are in a bad spot because they are forced to be your business partner when all they want to do is cash out and go on with their lives. So one of the most important things that we get in addressing these situations is, how do we create a market for the shares of a retiring, incapacitated, or deceased business owner? Okay, this is one of the most critical areas where the advice given to publicly traded companies and privately owned companies are night and day opposite. Okay, if you own stock in a company, let's say that you don't like the way that Meg Whitman is running your company, your shares, or Bill Gates is not running Microsoft, and you have a problem with that and you don't like it, what do? You call your broker and you dump the stock, and it's really easy to do so. It takes only a matter of minutes. They execute the trade and you're out. You no longer have to be tied into what Steve Jobs' company is doing at Apple, what Bill Gates' company is doing at Microsoft. You are on your merry way with your money. What happens with a privately held company? Well, here's the problem. If you are stuck in ABC Widgets company, There's no public market for your company. It's not like you can call a broker and say, get me out of my company. There's no market for it. There's no market for privately held companies. So you have to do the next best thing, which is create a market for your company. And the way that we do this is by setting up business valuations, valuing the sale price of your company, putting in buy-sell agreements, specifying what happens if one of the partners dies or is incapacitated, how they are cashed out, and then most importantly, you fund the agreement with life insurance or perhaps an employee stock ownership plan. So here's another question that we get a lot. How can the tax liability of a deceased owner be paid without ruining the company? Okay, so this has to do with the federal estate tax, which you hear a lot about in the public. What happens to the federal estate tax and how does that impact small business? So let's talk about that right now. So currently, in 2011, 2012, the federal estate tax kicks in at a maximum of 50% for estates over $5 million per spouse. In 2013, this will drop to $1 million per spouse, $2 million combined, unless Congress renews the numbers. The federal estate tax is due 9 months after the date of death. Okay, so if one partner dies and the company needs to cash them out, they have 9 months to do so. That's why life insurance is so critical to an exit strategy, because it allows you to pay obligations and cash people out within 9 months. Almost nowhere else can you sell a company or shares in a company, a privately held company, in less than 9 months. So having a buy-sell agreement which values the company, you got to fund it with life insurance. That's the most important thing. The tax bill can be paid quickly, easily, in time, and you can do this without liquidating the company or doing a fire sale of the assets. So let's talk about some of the key ingredients of a successful business succession plan. Number one, you have to value the company. And one of the most important things we tell people is after you get a valuation, that's not the last time you're ever going to value your company. You need to have something built into your buy-sell agreement that makes your valuations updated, your numbers updated at least annually. Okay, so just because you valued your company 5 years ago at $1 million doesn't mean it's worth that today. It could be worth a lot more or a lot less. So you need to specify in your buy-sell agreement your agreed formula for valuing your company and making sure that that valuation stays fresh. Number two, you have to specify what happens if a partner dies or is incapacitated, who gets the company. And then three, we talked about this before, you got to fund it with insurance or some other cash out or buyout so the company doesn't have to write a check for half or a third of its net worth, depending on the number of owners. So let's talk now about selling your company. Okay, so you've come to the end of your career. You've decided, I want to spend my time going fishing, playing golf, playing tennis, cooking, doing whatever you want to do when you're not running your company. So the most important thing is that a clearly defined exit strategy is required. Who do you want to sell your company to? Your kids? Do you want to sell it to the employees? Do you want to sell it to outsiders or your competitors? A lot of people don't think that your competitors are somebody that you want to do business with, but I'll tell you what, think about this. Think about your most toughest competitor and think about what you would pay to have them out of the marketplace so that you could have all their business for yourself. You'd probably pay quite a bit for that. They'd probably do the same for you. Here's another key. The key professionals have to be consulted early. If you ask the average business owner about how long is it till you want to retire or sell your company, they usually say about 5 years. And then if you check in with them about 5 years later, they'll say the same thing, about another 5 years. You got to put a plan in place together now, and you have to start with the end in mind. The key professionals need to be engaged early, and here's the most important thing. Okay, you have your attorneys, your valuation experts, your CPAs, your financial advisors, your life insurance specialists, your business bankers. Here's the most important thing. People who sell companies usually sell one, possibly two in their entire life. But people who purchase companies as a way of doing business do it all the time. They may do 3 or 5 per year. Companies who acquire other companies as a growth model are professional. Their team has been in place. They are a well-oiled machine. It's kind of like the difference between the Boston Celtics or the LA Lakers and your local pickup team. You grab a couple of your friends, go out on the court and say, hey, let's play some basketball together. And then the Lakers step on the court and you have to play against Kobe and Dwight Howard and all these superstars who are extremely talented but have been doing it together for a long time. That's what you're up against when you sell your company. That's why you need to get your professional team engaged early so they can do a thorough job for you. And finally, one of the most important steps to take before you list your business for sale is to make sure that your key people